Hello and welcome back to Channel 11. I'm Ken Shinoda, your host today, Wednesday, September 6th. And the title of our show today is, Are We There Yet? Are we there? Is a recession here? Is a soft landing here? Is all these things that we've been waiting for and watching for going to happen? I think that's what market participants are looking for these days. Well, let's crank right through it. August month-end returns. You see some slight negative returns across the board for equities. Actually, a deeper drawdown into mid-August. We saw a pretty meaningful rally through the end of the month. But NASDAQ still leading the way, up 35%. It was supposed to be the year for bonds, but it's a year for U.S. equities. It was also supposed to be the year for European outperformance, which hasn't happened, with almost looking like more recession risks there than obviously in the U.S. Japan has also been standout, with Japanese manufacturing making a comeback there, with the Nikkei up 26%. As we look at the drawdown that started at the end of July with the move higher in rates, peak to trough decline of about almost 5% in the S&P, about a little over 7% in the NASDAQ, but as we can see through the end of the month, pretty meaningful rally, recouping most of those losses and starting to roll over again here with rates backing up again. So we'll just have to wait and see. Seasonally, September can be challenging, but usually when you have such positive returns through the year for equities, the year turns out being a pretty good one. Here's an interesting slide that I found. This one came from Deutsche Bank, and we've noticed since the beginning of quantitative easing, going back post-global financial crisis, this chart starts in 2009, that there's been a very high correlation with QE, central bank balance sheet growing, and stocks doing really well here. This shows you the S&P 500 against the big central bank balance sheets globally, PBOC, ECB, BOJ, the Fed. And you can see a divergence. These stocks sold off with central balance sheet unwinding and QT starting. But very recently, we've seen a divergence with stocks obviously rallying pretty significantly, being led by a few stocks, and central bank balance sheets continue their unwind. So that's kind of an interesting slide. Looking at sector performance, it's been a mixed bag for the equity market. And there's a couple big leaders out there, the Magnificent Seven that a lot of people are talking about. That's a lot of big, large kind of mega cap tech out there, the Amazons, the Microsofts of the world. You can see that on the left-hand side, some huge returns in some of these in information technology, consumer services, real estate with kind of the headwinds of rates lagging. On the far right-hand side, some of those more value type equity sectors also not doing as well. So it's been this kind of divergence in the equity market. This is a great chart. This is not a story that is anything new. This is something we all know about. It's basically the lack of breadth in the market, in the equity market. On the top, you can see the leaders out there, that Magnificent Seven that has really been driving the returns of the S&P. And then we look at the S&P 500 in black. And if you take out all the Magnificent Seven, that's the returns of everything else in the red there. And, barely up on the year, I think up about 3-4%. So really most of the gains concentrated in a few stocks. And I think when you look under the hood, you can kind of see that it's really these big names in the equity markets, kind of like the top 10, 20% of the market that's kind of got a really healthy balance sheet. And then as you go down to the smaller companies, they are where they're feeling the pain from higher rates. So here in the red is net interest and payments of companies. And you can see that it's actually come down. So the net interest payments has come down. Why is this? Well, if you're Apple and you're sitting on, billions of dollars of cash, your cash was earning 0, and now your cash is earning 5.5% in 6-month T-bills. And you may have sold bonds, 2-3 years ago at much lower rates. And so you've locked in cost of funding at, let's say, 2-3%. And now the cash that you got from that you haven't spent on any investments is sitting there in your coffers earning 5. And so net interest costs has come down, but it is a mixed bag. So here you can see the top 10% of S&P is in the red. It's the red number on the top is the effective interest rate percentage, and it's barely moved, right? It came down to very low levels during kind of peak QE in mid 2015-16, and then again we had QE in 2021, and so effective interest rate levels very low. They're still pretty low even after this rate rise. The beige is the middle 40% of the S&P 1500 in this case, and then the blue is the bottom 50%. So the bottom 50% of companies, the smaller market cap companies, are seeing the brunt of the rise in interest rate costs. Now, part of this is maybe because they can't borrow in the IG markets. Maybe they borrow more in bank loans and high yield. Maybe they have to borrow more from, directly from banks at higher rates, or maybe in the commercial paper market. So then we look at interest coverage, which is showing the health of the balance sheet of these companies. And again, the red is the largest U.S. companies, and they have a lot of coverage on their interest costs. Look at the red line; it's up 12 times coverage. And the bottom 50%, the blue, you can see that coverage has been declining pretty dramatically. And then we've got the Russell 2000 on here in black, also, smaller cap companies that are barely covering their interest costs. They usually have about this 2 times coverage, so I guess it hasn't changed much. But what's really been struggling are those bottom 50%, that blue line, which I think kind of makes sense why the equity performance has been this mixed bag with this Magnificent Seven versus the rest of the market. Here's another view, another look at a similar theme on the left-hand side: S&P 500 ex financials and their debt schedule. So this just shows you what types of debt they're using, and the red, which is term loans, are pretty low. There's almost no gray. Revolving credit, there's almost no gray, and revolving credit resets the quickest in a rising rate environment. And bonds, which could be some high yield bonds, but it's likely more investment grade bonds, comprises most of their debt burden. And so they've locked in these really low rates, back during QE period. And I think this is one of the reasons that we're not seeing the transmission mechanism of higher Fed funds really hitting the economy so quickly, is that there's a lot of these big companies that have basically immunized their balance sheet for a while with these long-term bonds. Also the consumers' balance sheets with 65% home ownership and mortgage rates at 3.5%, locking that in. Now on the right-hand side, Russell 2000 small caps, right? Ex financials. And now you can see the percentage of this beige using bond issuance much lower, and it's got much higher utilization of term loans and revolving credit. Way more interest sensitive. And I think what we'll see happen as the Fed potentially stays higher for longer is that we will see more weakness in these types of companies. And that's something I think for everyone to be on the watch for out there right now. Let's talk about fixed income. This is just the month of August, which saw rates rise again, making some new highs across the Treasury yield curve. So you can see on the far left, you got more interest rate sensitive assets, lower risk assets, Treasuries, agency mortgages, some negative returns there, almost 100 basis points negative return for agencies, with spreads widening again on agency mortgages. As you go to the right-hand side, we've got credit assets. Spreads did tighten across the board, so that offsets some of the rate rise that we saw. And then floating rate assets did the best. Look at BBB CLOs up 2.1% on the month. CCC bank loans up almost 2% on the month. The ag down 60 basis points. So credit has been the place to be all year. This is looking at year to date now. Far left-hand side, you can see again Treasuries, agency mortgages, barely up on the year, up about 1%. As we look at the securitized space, kind of 2, 3, 4% returns for higher quality assets. As you go down the capital structure outside of CMBS, seeing better returns with a big winner. CLO, BBBs up 12%. If you were in CLO BBs, you'd be up probably 15+%. And we're only 8 months through the year, and there's a lot of carry to be had. So to the extent we don't see a sell-off in credit, some of these floating rate parts of the market, surprisingly to everyone's dismay, thinking that it was going to be kind of a winning year for Treasuries, losing year for equities and credit risk, they could be some of the best returns being in credit, especially short duration credit's been the place to be. Through August, ag up 140. The first day of the trading day of September was a bad day. That's erased even more of the returns out of the high quality parts of fixed income. Treasury yields, before we got that positive GDP print, it looked like we had seen the highs in the 10-year last year, October, and maybe the 2-year right before SVB, but a wave of positive economic data caused us to make new highs almost across the curve, but it looks almost like a double top in across the curve. So I think Treasuries are one of the big value buys out there. They're one of the most beaten up sectors. It's almost like there's been no good news for Treasuries for the last couple months. You've had huge issuance of Treasuries, record low foreign buying. You've had economic data surprise to the upside. You've had the Fed remain hawkish. So there's just not much positive that you can say about events related to the bond market, which is why bond yields are where they are. But that leads me to believe that from a buy low standpoint, this is a pretty interesting time to add Treasury yields or bond yields to your portfolio, given just where we are from a trade location. Yes, could the yields go higher? Sure. But with the kind of yields you have today, 10-year Treasury with a 4 and change yield, it's 430-ish today, you could see rates back up, and you're not going to really lose that much money relative to what you're earning in yield. This is a look at valuations. So on the left-hand side, this is the PE, forward PE of the S&P 500. You can see it's a 20-ish handle. I guess after the rally, this was 20 handle a couple days ago. After the rally, we're back above to a 21.7. And so obviously, if you're above that line, looking back 20 years, you're going to be cheap. If you're below the line, expensive relative to that average. You can make arguments that, different from 20 years ago. We've got a lot of more growth companies in here, and you've got artificial intelligence and things like that. So maybe the average PE from the prior decade, starting before the global financial crisis, isn't the appropriate PE today. But nonetheless, that's the data. And on the right-hand side, you can see Treasury yields, long-term average, going back 20 years, 3% yield. And now we're up here at this is like a day stale. It's 430 now, before I left my desk. Again, looking on the cheaper side. Could it go higher? Sure. But, you got to kind of leg into these things. When you compare the two and you compare the earnings yield, right, E over P, relative to the 10-year yield, you can see that there's a kind of a dotted line here, and when you're below that dotted line, bonds look cheaper, and basically they're the cheapest they've looked since kind of the early 2000s. So, and that's after the dot-com correction. So I think pretty interesting time to own bonds. It's obviously been painful. Everyone looking for the year of huge Treasury returns, but we've now been 3 years since the start of the bear market. The 10-year Treasury yield on a closing basis, low was in August of 2020, around 50 basis points. And here we are today around 430, making new highs last month. So it's been 3 years of the bear market in bonds. Not so fun as a bond investor, but what that's led to is a ton of opportunity out there. So we'll talk about some things that are positive for Treasury yields, some things that are negative for Treasury yields. This is on the positive side. This shows you economic surprise. This is the Citi Economic Surprise Index that takes in different data points that come in that surprise to the upside. And you can see the blue line had been moving higher. A lot of economic surprise to the upside coming out of SVB, right? March hit, you have this collapse in some economic data, and you've seen this consistent move upwards, and rates have moved up with that. Now, until this recent blip higher in the Citi Surprise Index, which guess what, has taken yields up with it, it looked like that had been turning over. So let's watch this. Let's see how this develops. If the surprise index, I think, continues to move in a downward trajectory, that is assisting the peak in Treasury yields. If this moves back higher, then I would say we're going to see maybe, again, a retest of the near-term highs in yields, or maybe break higher from that. But we've had a lot of positive data here. It seems like the chances are more for maybe surprise to the downside, especially from levels we saw today in the manufacturing PMI. Another positive for rates is that break-evens which are the market's expectations of inflation, remain well anchored. This is the 2-year, 5-year, 10-year, and 30-year break-evens, kind of like a rock moving sideways. So to the extent that we don't see a breakout here, I think that this is positive for Treasury yields as well. Jobs data came in better than expected. The rally we saw kind of from like that new high all the way down kind of to back to that 408 level on the 10-year. That was because of the most recent jobs report. We were up at one point 11, 12 million job openings. We dropped down to 8.8 million on the last print, which was below expectations, expecting something more like 9.2. And so I think this is something to watch. To the extent that blue line comes down with lower job openings, that's cooling in the labor market. And in conjunction with that is wages. Wages are still elevated. There's still wage growth. The rate has been coming down. So let's watch this. This is something we look at every month when this data comes out. And we want to continue seeing this come down. So if city surprise comes down, if job openings keep coming down, if wage growth keeps coming down, these are all signals that the Fed is looking and watching, and those are positive. Today, we got a little bit of negative too. We got that PMI number, services PMI in the red. It had ticked down a little bit, now going back up. Still, by the way, if you go back through the mid kind of 2010s, it is still on the lower end of the range for services. So it's not like services are going gangbusters like they did right after COVID with the stimulus checks, but we're not sub 50, which is below growth. So manufacturing has been in the sub 50 area for many, many months now. Economy is heavy, services. And so again, one of those data points that the markets are watching. Now, commodities, negative on the year, which is, I guess, good for the inflation story. But look at WTI now up 8%. And that's part of headline CPI is going to be energy prices. It's going to cut into consumer spending. Gasoline prices are on the way back up. And so while kind of industrial metals and copper and things like that have kind of lagged given the slowdown in growth out of China, watch out for that oil. If you look, this is a chart of Brent crude. We got down into that kind of like 70 area on the lower end, and you've had this big breakout in price, and you've had some production cuts coming out of Saudi Arabia and Russia as well. So maybe that's fuel to the fire to help energy prices stay up. That'll bring headline CPI back up, but that should maybe dampen some consumer spending. So kind of a mixed bad for inflation, but maybe slows consumer spending. But again, something to keep our eyes on. With rates going higher, the dollar pretty volatile this year. You can see that it finally broke through for a brief moment that kind of support level, which was around kind of like I think 101-ish, and then breaking back higher to its 200-day moving average. This is just moving with rates, right? Rates went up before SVB in March. Rates came down. As rates came down, the dollar weakened. Rates started going back up. And so now with our rates higher and maybe Europe perhaps seeing more recessionary pressures out there, maybe they're closer to a pause. The dollar's been on a run. Dollar being stronger, not good for EM, right? And part of the reason the dollar is doing well is also that economic growth in the U.S. has been surprisingly upside relative to other economies outside of maybe Japan. So what's the market thinking now? This is the market's expectations for Fed funds. The market is pricing almost a 50% chance of a hike in November, nothing in September. And so the market's almost saying the Fed's done. So maybe coin flip, they raise rates one more time. And the market actually thinks the Fed's going to cut by kind of July of next year, one full cut by July of next year. We'll see. This means the economy is going to slow if this is accurate. A lot of debate here amongst market participants that maybe the market's a little bit too dovish and nothing will happen until the end of 2024. So, I think that we got to be patient. The economic data is a mixed bag. We've had some surprises to the upside. Rates are really high. We looked at how it's affecting these smaller companies. Bank lending has slowed down. The 3-month 10-year inversion happened October of last year. I think you got to give that at least 12 months. October is coming up. And so I think what's really important is the fourth quarter. So I want to wait and watch fourth quarter data. I think we're going to see slowing. We're probably not going to see a recession. Atlanta GDP now is almost 6% for the third quarter. But I do think that we don't see continued gangbusters growth given some of this, the backdrop of higher rates and the running out of the savings, the pent-up savings from the pandemic. And so I think we see a kind of a slowing in Q4, and that should be good for rates too. So these are all things that are, I think, positive. Now, if that WERP screen, this is what we were looking at, the WERP screen saying that the Fed is basically almost done and maybe cutting, if they're right, let's look at history. History shows you that Treasury yields have historically rallied following the last Fed rate hike and into the first cut. So this goes back through the early 2000s, through the pre-GFC when the Fed cut, or during the GFC, and then when we cut after that kind of the famous Powell pivot in 2018. And you can see that rates fall across the board. They fell over 100 basis points at the front end of the curve. The front end of the curve obviously has the most room to fall, and the back end of the curve goes up more in price, but falls less. You can see in 2007 and 19 went down about 70 basis points or so. So what does that mean for total returns? Well, that's good for bond returns. You can see over these time periods, 1-year returns across fixed income. This is looking at a mix of the ag, the Treasury index, and those are the longer parts of the market, and those are the ones we've highlighted here. And you can see the 1-year 3 returns pretty strong, right? 7 to 8% type return over a 3-year time horizon after the Fed has done its last hike and is going to cut. And if the market is right, based on that world interest rate probability screen in Bloomberg, that means that the future returns are going to be pretty good for the higher quality parts of the fixed income market. So that's Treasuries. I think it's a value buy. It's scary because rates have moved higher. And outside of Treasuries, agency mortgages and CMBS, we've talked about it a couple times here on the show. They still look cheap. It's just going to take time for that value to be realized. What looks expensive, which means it's done really well, is down at the bottom here, IG and high yield. IG is now on a 10-year look back of spreads. IG is 39th percentile, high yield is 37th percentile. That means that the spread has been wider, for example, 63% of the time over the last 10 years on a trading day basis. The wider this number, or the higher this number, the closer to 100 you are, the cheaper you are relative to your own spread history. And mortgages just scream so cheap right now, which means they've underperformed, right? They've underperformed corporates. Corporates have tightened in spreads. Mortgage spreads are wider on the year. In fact, corporate spreads have come in and mortgage spreads are wider. They're not at their wides. They've been a little bit wider. But the blue line on the top, that's the current coupon mortgage spread. The red line on the bottom is the IG CDX, investment grade corporate bonds CDX, where you can get long synthetically corporate bonds. You can look at the difference between these two spreads is 99th percentile going back 10 years. So it's only been cheaper 1% of the time going back 3 years on a relative basis, asset class to asset class. No credit risk in mortgages, and credit risk obviously in corporates and tight spreads. Why have mortgage spreads suffered? FDIC supply of Silicon Valley Bank assets, billions and billions and billions of bonds being sold. Also, rate volatility and mortgage spreads are correlated. And so here you can see that mortgage spread is in red. It got all the way up to 190 handle in May. And the 10-year Treasury yield is in blue. And when the 10-year Treasury yield is moving up, usually rate vol is high. And you can see that they move kind of together. So to the extent that the 10-year yield has peaked, which we talked about earlier, and comes down, which brings rate vol down too, then that's one catalyst that could be positive for MBS spreads. The other thing is that FDIC supply. We're through about 80% of the supply. They've sold most of the pass-throughs, I think all of the pass-throughs. And what's left to be sold are the collateralized mortgage obligations and Ginnie Mae project loans. And there's probably about 12 more weeks to supply, which puts us through the end of Thanksgiving time period, which is something we've also talked about on the show, that once that supply comes through, the market's going to wake up. They're going to look around for bonds. There's basically almost very low production of mortgage bonds, given very low activity in the housing market and purchasing of homes. And that could help tighten spreads. And look, they got as tight as 120 at the beginning of this year. I'm not saying they're going to go from where they are today to 120, but with a 5-year spread duration assets, 20 basis points of spread tightening could create about 100 basis points of excess return for mortgages. So I think it's an interesting place to look at where there's value out there. The other place where we've seen value is the securitized credit markets. We've looked at these charts in the past. This is relative to corporates, what looks cheap. And our view was that these lines would converge and come back towards long run historical averages. The long run average between these spreads and corporate spreads is that black line. And we can see that CLO spreads in the top right have almost come back, and so that worked. Non-agency spreads, not quite back, but getting close. A little bit more room to run. ABS in the bottom left, a little bit more room to run. And CMBS, as we noted in the chart before, definitely standing out. Just huge deviation relative to historical averages. And so we think that there's more excess return to be had from these sectors, given that corporates have rallied so much. And we've seen it. This might be a little bit hard to see on your computer screen. You got to zoom in. But what this shows you is the excess return last year, which was basically negative across the board for all sorts of spread assets. And on here, I've got everything from agency mortgages to corporate bonds, high yield, for example, negative 3.5% excess spread relative to swaps last year. And on the left-hand side here, you can see the last 12 months, almost positive excess return relative to swaps across the board for credit assets. I mean, some huge numbers. For example, high yield, as we noted last year was negative 3.5 excess return. This year, plus 7. You've got credit risk transfer, plus 10% excess return. You've got CLO double Bs, plus 11% excess return. And then we go down here and we see CMBS, negative almost 100 basis point excess return. Agency mortgages, negative 100 basis points excess return. So spreads are tighter everywhere in the credit markets except for agencies and CMBS and some of this legacy non-agency market, so which is correlated to agencies. So that's where the value is, I think, where you've seen some underperformance. It's hard for some of the mortgage credit markets on the high grade side to rally when agency mortgage spreads are wide. But to the extent that those play catch up to corporates or corporates widen, that's another way to outperform from where we are today. I think that that's where the interesting upside is in the credit markets today. So thanks again. Hopefully this was informative. Thanks for your support at DoubleLine. Good luck out there for the rest of the year. We'll catch you next month on Channel 11. Thanks.